back to the deep dive. We are jumping into a topic that I know a ton of you have been asking about, commodity stocks.
Yeah, so much going on in this space right now. It's been making headlines, and it can be pretty tough to cut through the noise and figure out what the key takeaways actually are for investors.
Exactly. And I mean, commodities, it's one of those things that affects all of us in some way, right?
Absolutely, yeah.
Like we're talking about the raw materials, the stuff that goes into our food, the energy we use, the clothes we wear, it's all connected.
The things we just can't live without, basically.
Totally. Yeah. So today we're trying to make sense of this whole world of commodity stocks. And to do that, we've pulled together some really interesting sources. We've got a recent NerdWallet article that's like, okay, these are the 14 best performing commodity stocks right now as of March 2025. They're looking at the Fidelity Global Commodity Stock Fund, FFGCX.
Yeah, that's a good one to track for a sense of what's hot in the market.
Then we're also diving into Investopedia, which, always a good resource for understanding how things actually work. We'll look at their explanation of the commodity market itself, like the mechanisms and all that.
Makes sense. The nuts and bolts.
And then to round things out, we've got a really thought-provoking analysis from Lazard. They're arguing that commodities deserve a strategic spot in any well-rounded portfolio. So we're going to dig into all of this, try to extract the gold nuggets, if you will. What are the benefits of investing in commodity stocks? What are the risks? And how do they perform compared to, say, your traditional stocks and bonds?
Yeah, we're trying to figure out how this all fits together.
Right, right. Okay, so let's start with what's been grabbing everyone's attention lately. Performance, that NerdWallet piece, they're looking at the market as of March 12th, 2025, and they highlight some pretty impressive gains over the past year.
What strikes me right away is that, the top performers, it's not just one sector dominating, it's really diverse. It's telling us that there's a lot going on across the commodity landscape.
Yeah, for sure. At a very top, you've got Abnakau Eagle Mines. They're up over 85% in the past year.
Wow, that's significant.
Yeah, then you've got Targa Resources. They're in the energy infrastructure space. They're up over 77%. And Alamos Gold, also over 77% growth.
So precious metals, energy, what else is up there?
Yeah, and then Pilgrim's Pride, they're in the agricultural sector, chicken, all that. They're up almost 65%. And wheat and precious metals, they're up 58.5%. So it's a real mix.
It does seem like different factors are pushing each of these areas, right? You've got precious metals, energy, food production, all responding differently to what's happening in the world.
Right, right. And it's not just the super high growth stories either. NerdWallet also points out that, some of the more established players, they're seeing more modest but still positive returns. Shell was up about 3% and ExxonMobil was up just under 1%.
So a bit more stable maybe, but still upward trend overall.
Yeah. So, okay, we keep saying commodities, commodities, but before we go any further, maybe we should actually define what we're talking about here. What is a commodity? Investopedia gives a pretty clear explanation.
Yeah, they say it's basically a market, more and more often online these days, where you buy and sell these raw primary goods. What the key is that they're pretty much interchangeable. No matter who produces them, a barrel of oil is a barrel of oil, pretty much.
Right. You're not looking for brand name oil or anything.
Exactly. It's the basic stuff, the building blocks.
Right. And Investopedia, they divide things up nicely into hard commodities and soft commodities.
Yeah, that's a good way to think about it. Hard commodities, those are the things you extract from the earth, right? Through mining or drilling. So gold, rubber, oil, those kinds of things.
Okay, makes sense.
And then soft commodities, those are grown or raised. So we're talking about agricultural products, livestock, things like corn, wheat, coffee, sugar, soybeans, even pork.
So across both categories, we're really looking at the essential ingredients for, well, pretty much everything, right?
Yeah, I mean, think about what you eat, the energy you use to get around, the materials in your house. It all starts somewhere,
Okay, so why would someone want to invest in the companies that deal with all of this stuff? NerdWallet, they lay out some pretty compelling advantages, and the first one is hedging against inflation.
Yeah, that's a big one, especially with all the talk about inflation lately. Basically, the idea is when prices in general go up, that's inflation, right? The prices of these basic commodities, they tend to rise too.
Because they're needed for everything else.
Exactly. So if you own stock in a company that produces these commodities, their revenue and profits could go up too, right? And that could boost their stock price. So in a way, commodity stocks can act as a buffer in your portfolio, maybe helping you keep pace with inflation.
Okay, that makes sense. The value of the underlying goods is going up, so the company benefits. What's the next advantage NerdWallet talks about?
Well, they also mentioned diversification. And this is huge, it's spreading your risk. The commodity space, it covers so many different parts of the economy. We're talking energy, food, materials for manufacturing. And all these sectors, They're often driven by different things than, say, tech stocks or retail.
Right, different forces at play.
Totally. Like the price of oil, it might swing based on, I don't know, some international conflict or a pipeline disruption. But a tech company, its stock price might be more tied to, like, innovation or consumer spending habits.
So it's like they don't all move in the same direction all the time.
Exactly. And that's the beauty of diversification. Because if commodities are doing their own thing, maybe even going up when the rest of the market is down, it can smooth out your overall returns, right?
It's like having a backup plan in case one part of your portfolio is having a rough time.
Exactly. And NerdWallet also points out many commodities are necessities, right? Like people still need to heat their homes and eat, even when the economy's not doing so well. So in a way, some parts of the commodity sector, they can be more resilient.
Okay, yeah, that makes sense. And the third potential upside NerdWallet mentions is dividends.
Yeah, this is an interesting one. It's not a guarantee with commodity stocks. Like, not every company pays dividends, but a lot of the well-established players, especially in the more, let's say, mature sectors like energy, they do have a history of paying dividends.
So it's like an extra bonus on top of potential stock price growth.
Yeah, for sure. And for investors who are looking for both growth and income, it can be a pretty attractive combination.
Okay, so we've got NerdWallet's take now. Let's jump to that Lazard paper, which, as we mentioned, kind of takes a bigger picture look at why commodities can be a smart addition to a portfolio.
Yeah, and they really emphasize the diversification argument, but they go a bit deeper. They talk about how, for a while after the financial crisis back in like 2008, the diversification benefits of commodities kind of faded because their prices were moving more in sync with stocks and bonds. But now their analysis suggests that things are shifting back. Like we're seeing less correlation, especially between commodities and bonds.
So it's like commodities are becoming more distinct again.
Exactly. And that means they could, once again, play a more effective role in diversifying a portfolio, potentially acting as a counterbalance when other investments are struggling.
They also make a point about liquidity in commodity markets. So for someone who's not familiar with that term, can you break it down a bit?
Sure. Liquidity basically means how easily you can buy or sell something without really messing with its price. Like think about a really rare collectible, right?
Where there's only a few in existence.
Yeah, exactly. It might be hard to find a buyer, and you might have to sell it for way less than you want just to get rid of it. But with commodities, Lazard's saying that there's so much trading going on every single day, especially those futures contracts we talked about earlier, that you can typically get in and out pretty quickly without causing big price swings.
So it's like there's always someone willing to buy or sell.
Pretty much, yeah. And that could be a big advantage, especially compared to some other investments that might be harder to get out of quickly if you need to.
Okay, that's a good point. And then there's this idea also from Lazard that commodities can be a hedge against geopolitical risk. Especially given everything that's going on in the world right now, this seems super relevant.
Yeah, it's front and center these days. Think about the war in Ukraine, right? That's had a massive impact on energy prices, food prices. It's created a lot of uncertainty and volatility. And often when these kinds of big global events happen, commodity prices can spike, even when stocks and bonds are taking a hit.
So it's like they offer a bit of protection.
In a way, yeah. Lazard actually includes data that shows how in 2022, when there was a lot of geopolitical tension, commodities actually outperformed stocks and bonds by a significant margin. So having some exposure to commodities might help cushion your portfolio against these unexpected global shocks.
Okay, so we've talked about the upsides. Now, what about the risks? What are the potential downsides of investing in commodity stocks? NerdWallet, they hit on a few important things.
Yeah, one of the biggest risks they emphasize is just how much political and climate events can influence prices. Like these are things that are completely out of the control of any individual company. A sudden drought could wipe out a whole crop, for example, or a trade war could totally disrupt global supply chains.
And that creates volatility, right?
Big time. It could lead to these huge swings in prices, which, could be nerve-wracking for investors.
And, of course, NerdWallet points out that you're also taking on the usual risks that come with any individual stock. Like if you buy stock in a specific commodity company, even if the overall commodity market is doing well, that particular company could still face its own problems.
Absolutely. Like maybe they have bad management, or there are problems with their operations, or they take on too much debt. Those are company-specific risks that can hurt the stock price, regardless of what's happening in the broader commodity market.
So picking the right companies is important.
It is, yeah. And this is where NerdWallet brings up commodity ETFs, exchange-traded funds. Those could be a good way to diversify away some of that individual company risk because they hold a basket of different commodity-related stocks.
So less risk tied to any one company's fate. Okay, and Lazard, they also delve into the risks, focusing a lot on the supply side of things. They talk about these geological and geographical factors. What do they mean by that?
Well, they point out that when you're talking about extracting resources like, say, oil or gold, the geology of the deposit can make a huge difference. Like, not all oil fields or mines are created equal. Some are easier to access, some have higher quality resources. And that affects how much it costs to produce.
So, like, the physical characteristics of the location matter.
A lot, yeah. And then there's the geographical factor, which is basically where the production is happening. Lazard points out that a lot of commodity production takes place in countries where the political or economic situation is a bit shaky.
So, more risk.
Yeah, it adds another layer of risk, like you might have to deal with unpredictable regulations, or maybe there's a risk of the government nationalizing the industry.
So, not just about the resource itself, but also the environment it is.
Exactly. And then they also talk about this idea of slower supply growth, which they think could lead to scarcity down the road.
Scarcity, like not enough to meet demand.
Yeah, that's what they're suggesting. They say there are a few things pushing in this direction, like investors are putting more pressure on companies to get higher returns on their investments, so companies are less likely to take on risky long-term projects.
Makes sense.
And then there's this growing focus on environmentally sustainable investing, which can make it harder to get financing for new projects that might have environmental impacts.
Yeah, that's definitely a factor these days.
On top of all that, a lot of the big commodity companies, they're more interested in buying up existing production capacity rather than investing in developing new sources. Like there have been some big mergers and acquisitions lately. ExxonMobil buying Pioneer, Chevron going after Hess, BHP making a bid for Anglo American. So it's like they're consolidating, which could mean less new supply coming online.
Okay, so potentially a recipe for scarcity in the future.
Possibly, yeah. If demand keeps rising and supply growth slows down, it could create a pretty tight market.
All right, well, let's shift gears a bit and talk about how these commodity markets actually work. Investopedia does a good job of breaking things down, distinguishing between those spot markets and the financial or derivatives markets. Can you explain the difference for those who aren't familiar with all the jargon?
Sure. The spot market is pretty straightforward. It's basically where you buy and sell the physical commodity for immediate delivery. Like you're buying a barrel of oil right now and expect to get it soon. But financial markets or derivatives markets, they deal with contracts, like futures and options. And these represent the right to buy or sell a certain amount of a commodity at a set price in the future.
So it's not about actually getting the commodity right away, it's about locking in a price for later on.
Exactly. And these markets, they play a really important role for both producers and consumers.
How so?
Well, for producers like farmers or mining companies, these contracts can help them manage risk, like they can lock in a selling price ahead of time so they're not as exposed to price fluctuations. And for consumers, like airlines buying jet fuel, they can use these contracts to protect themselves from price increases.
So everyone's trying to manage uncertainty about the future.
That's a big part of it, yeah. And then you've got speculators who are basically trying to profit from predicting which way prices will go. So it's a pretty complex ecosystem.
Investopedia also mentions the major U.S. commodity exchanges like ICE Futures US, CBOT, CMB, EMEX. What's traded on those?
Oh, just about everything you can think of. Agricultural commodities like corn, soybeans, energy products like crude oil, natural gas, metals, coffee, sugar, cotton. It's all there.
So these are like the central hubs for commodity trading.
Exactly. They provide a regulated and transparent marketplace for buyers and sellers.
Now, for listeners who might be more comfortable with the world of stocks, Investopedia also outlines some of the key differences between trading commodities and trading stocks. What are some of the big distinctions to keep in mind?
Well, the most fundamental difference is what you're actually buying, right? With stocks, you're buying ownership in a company. But with commodities, you're buying a physical good.
Like the actual stuff.
Yeah. And that leads to a difference in who's involved in the markets. Commodity markets have a lot more direct participation from the producers and users of the actual commodities.
So it's not just investors buying and selling pieces of paper. There are actual companies involved in the physical production and consumption of the goods.
Right. And the returns you get from these investments also tend to be different. With stocks, you're looking for capital appreciation, the stock price going up, and maybe dividends if the company pays them. But with commodities, it's more about buying low and selling high, profiting from price movements.
So different ways to make money. What about the risks?
Well, stocks are very sensitive to how well the company's doing, the overall economy, investor sentiment, all that. Commodities, as we've talked about, they're more influenced by things like global events, weather, and the balance of supply and demand.
So it's like different forces at play again.
Yeah, definitely. But it's important to remember that commodities can also act as a hedge against inflation, which can hurt stock returns, so they can play different roles in a portfolio.
Okay, that makes sense. And finally, Investopedia talks about the methods of trading in these markets. Like, how do you actually buy and sell commodities?
Well, these days, stock trading is almost entirely electronic, but with commodities, there's still a bit more connection to the physical movement and storage of goods, especially in that spot market we talked about earlier.
Where you're buying the actual commodity.
Exactly. And while electronic trading is common in the financial markets for commodities, the world of derivatives like futures and options, it can be a bit more complex for individual investors compared to just buying and selling stocks.
Okay, so maybe a bit more of a learning curve there. Now, Lazard, they also talk about some big long-term trends that they think are going to shape commodity markets in the coming years. They call them structural demand trends. What are they seeing?
Well, they point to a few major global shifts that are going to drive demand for commodities. One is this huge need for global infrastructure development. Like, think about all the raw materials you need to build roads, bridges, energy grids, all of that. Concrete, steel, copper, it's a massive amount of stuff.
Yeah, especially as countries are developing and populations are growing.
Exactly. And then there's the shift towards electrification, more electric vehicles, upgrades to power grids, all of that is going to require a lot of copper. And Lazard points out that it takes a really long time to bring new copper mines online, so there could be some serious supply constraints down the road.
So potentially a big opportunity for copper producers.
Yeah, potentially. And then they also mentioned artificial intelligence, which is something I hadn't really thought about in this context.
How does AI affect commodity demand?
Well, think about all the computing power you need for AI. Those massive data centers, they use a ton of energy, way more than traditional internet usage. So as AI becomes more and more prevalent, it's going to indirectly drive up demand for energy.
So another factor pushing up demand.
Right, and then of course you've got the more basic drivers like population growth and the need for more food. As the world's population keeps growing, we need more grains, more fertilizer to grow those grains. And things like bad weather and political instability can disrupt agricultural supply chains, which can push prices up even further.
Yeah, those are the factors that always seem to be in the news.
Right. And then on top of all that, you've got the growing demand for biofuels, which also uses agricultural commodities. So there are a lot of forces pushing up demand across a range of commodities.
Okay, so potentially lots of opportunity, but also lots of risk, as we've discussed. Finally, Lazard briefly touches on this idea of active management when it comes to investing in commodities. What do they mean by that?
Well, they basically argue that because commodity markets are so complex, all those supply and demand factors, the different ways you can invest, the potential for things to get out of whack, it can be helpful to have a more hands-on approach. They think skilled active managers can potentially spot opportunities, figure out the best way to get exposure, and ultimately generate better returns.
So not just passively tracking an index.
Right. More like using their expertise to try to beat the market.
Okay, well, as we wrap up this deep dive into commodity stocks, what are the key takeaways you'd like our listeners to walk away with?
I think the big picture is that commodity stocks, they can be a really valuable part of a portfolio. They can help with diversification. They can potentially protect against inflation. But it's super important to understand that they come with their own unique risks, often linked to things like global events and supply and demand dynamics.
Right, so definitely not a one-size-fits-all investment.
No, definitely not. And it's important to do your research and understand how commodities fit into your overall investment goals and risk tolerance.
And as always, our goal with these deep dives is to give you a solid foundation of knowledge based on what the experts are saying.
Yeah, we've covered a ton of ground today, from specific stock performance to how commodity markets actually work to the big long-term trends that are shaping the future. Hopefully this gives everyone a better sense of how to approach this complex but really important part of the investment world.
So here's a final thought to ponder. Given those big demand trends we talked about and the possibility of supply getting tight in the future, how might you strategically incorporate commodities into your own investment strategy? Food for thought as you move forward.